Welcome to Tradespoon. My name is Vlad Karpel. I'm the founder and CEO of Tradespoon. And today I'd like to continue our discussion of technical analysis. We had some basic foundation about trends, support, and resistance. Now I want to get into some of the upper studies and lower studies. So let's take a look at Bollinger Bands, which are considered to be upper studies. Take a look. So why are Bollinger Bands important? First, in this series, we will take a look in terms like Bollinger Bands, oscillators, and trend indicators. A moving average envelope creates a channel that parallels a moving average, and it allows you to identify the trend and use the upper and lower boundaries as support and resistance levels are, which are very important. Bollinger Bands are a modification of moving average envelopes. Rather than surrounding the moving average by a constant percentage, Bollinger Bands are a measure of historical volatility to adjust their bandwidth. Trending indicators cannot be used alone and should be always used in combination with oscillators and other technical indicators such as Tradespoon price level predictions. And you can see on your screen the Tradespoon chart that shows you moving averages. It also shows you different other upper and lower studies that you can use in conjunction with Bollinger Bands. So here's an example of Bollinger Bands. I personally use them to measure market volatility and to look at the trend, whether the market is oversold or overbought. The lower band on your screen, this is considered to be an oversold condition. Trends Bollinger Bands are similar to moving average envelopes with one key distinction. They reflect volatility. You construct Bollinger Bands by applying a simple moving average, usually 50 days, to a stock and then applying an envelope to the moving average. This means that the range between the two Bollinger Bands at any given time represents 95% of the price movement or trading range for the past 50 days. Keep in mind, Bollinger Bands is a reflection of past performance of underlying asset. Each strategy using Bollinger Bands relies on the indicator's excellent ability to identify volatility levels. So let's look at the squeeze. Squeeze takes advantage of sudden volatility increases that generally occurs after a period of constrained volatility. When a stock trends in a flat range, the bands constrict and eventually become very narrow. In most cases, when a stock price has been constrained for a prolonged period of time. So when you look at the Bollinger Bands, you want to see if they are narrowing. That means that the distance between upper band and the lower band is getting smaller. That means that at some point we are waiting for a binary event and volatility is about to increase. This increased volatility causes the Bollinger Bands to widen dramatically. This means that the range between the two Bollinger Bands at any given time represents 90% of the price movement. Just keep that in mind. So here's an example of the squeeze. You can identify potential squeeze trades when Bollinger Bands constrict to its narrowest position, and you can see it on your screen right now. You're looking at the daily chart, and you're looking at the daily chart of Groupon. So buy signal is SPX broke above its moving average. So in the case of S&P, this is at 1950. The index exceeded the upper